So I bought Progressive a couple months ago, and so far, this is how the stock has performed for me. Now, 7% in a couple months is great, but if you watch my previous videos, and you know that I'm not too much concerned with this figure. See, I only get the 7% if I sell my stock, but I don't want to sell my stock because while I own it, it pays me cash. Now this is what I'm looking at. That's cash paid to me. I can put it in my pockets and spend it however I please. So for the last couple months that I've owned Progressive, so far it's paid me $4.50 for each share that I own. So let's look under the hood, so to speak, to see if Progressive is a company that you might want to buy and add to your portfolio so we can start putting cash in your pockets. Welcome back to the channel that simplifies the stock market. In this video, we're going to do a quick analysis of Progressive, the business, so we can make a determination on whether or not we should buy Progressive stock. Now, before I buy a company stock, I always look at the business. And this is something that you're going to have to do too if you actually want to make money in the stock market. So I have a bit of a checklist. I'll put it up right here. And this checklist helps me to buy great companies or stocks at great prices. Because when you develop the habit of buying great companies at great prices, you're bound to make a lot of money in the stock market. So now we're going to go through this checklist while looking at Progressive. So first up, what does Progressive do? We got to understand the business if we're going to hand over our money to somebody in order to buy the business. So let's look at Yahoo Finance to see what it does. So when we pull up Progressive in Yahoo Finance and click on the Profile tab and scroll down to the bottom, we can see the description of the company. And in the first sentence, we can read that the Progressive Corporation, an insurance holding company, provides personal and commercial auto, personal residential and commercial property, general liability, and other specialty property casualty insurance products and related services in the United States. Okay, cool. So insurance is a business that I can understand. The customer hands over cash to Progressive in exchange for insurance from Progressive. So simply put, the customer goes to Progressive and says, hey, I'm going to hand you my cash right now so that if any damage happens to my house or my car, I can file a claim and you'll pay for it. And Progressive says, yes, we will, if your claim qualifies. That's some slick right there. Right? Now, the beauty of this business from an owner standpoint is that the customer is handing over money for a service that they might not ever use because they may never get into a car accident or a tree may never fall down on their house. But the company still gets the cash that the customer has paid. And then they take that cash that the customer has given them and invest it so they can earn even more. So we now know what Progressive does and how it generates its revenue. So we can now move on and look at some numbers. So in other words, what does the money look like? And for this, we'll look at Progressive's revenue trends and earnings trends. Okay, so I've pulled up Progressive in macrotrends.net so we can look at the breakdown of their revenues over the years. And up top, you can actually see a visual representation of how their revenues have trended over time. You can see how it's going upwards, which is a good sign. But we can go back down to the bottom so we can actually calculate how much growth they've had. Now in 2005, we see that their revenues totaled to $14.3 billion because these are in millions of dollars. And then when you go to last year, 2020, you see that revenues have grown to $42.6 billion. So this shows us that in the last 15 years, Progressive has grown its revenues by around $28.3 billion, which is a good sign because it shows that the company is growing. And now we can calculate the percentage amount for how much growth they've had. And we see that in the last 15 years, their revenue has grown by close to 200%. And we can divide that by 15 because it's 15 years total to get the average growth per year. And that equals about 13% average revenue growth per year. Now, this isn't a set in stone guideline, but I actually like to invest in companies that have at least 15% average revenue growth per year. Now, Progressive's 13% doesn't meet that, but I feel pretty good about a large insurance company growing at 13% on average per year. And now we'll look at Progressive's net income or earnings over the same time period. And I like to see a company's earnings in line with their revenue. So here, I also want to see at least 15% average growth per year. Now, when we look at this chart, we see that in 2008, when everything crashed down, they actually had an unprofitable year. But let's go ahead and calculate how their earnings have grown over this 15-year time period. So in 2020, last year, they had net income totaling up to $5.6 billion. And back in 2005, they had a lower amount of $1.3 billion. So this shows us that over this time period, net income has grown by $4.2 billion. And then when you get the percentage of that growth, it equals over 300%. And you divide that by the total number of years to get the average growth per year. And that equals about 20% average net income growth per year. So the company's net income has grown faster than their revenue, which is a good thing because it tells me that the company has done a good job of cutting their costs over time while still increasing their sales. So Progressive's revenue and earnings have been looking good. Next, we'll look at Progressive's profit margin. And again, not a set in stone rule, but when I'm looking to invest in a company, I want to see that they have profit margins of at least 10%. Now, I've made a video on profit margin, and you can go back and watch that if you want to understand the why behind it. So let's look at it on Yahoo Finance. Okay, now the profit margin is a quick one. And then over time, once you do it over and over and over again, you'll be able to come up with a rough estimate by just looking at the income statement and calculating it in your head. And you calculate the profit margin by taking the net income, which is $5.6 billion in Progressive's case, and you divide it by the total revenue, which is $42.6 billion. And then you multiply that figure by 100 to get the percentage, and it equals around 13.3% for Progressive. Okay, cool. Now, so far, Progressive is looking like a solid company. But now we got to concern ourselves with cash. How will the company put cash into our pockets? So if we bought Progressive today, we need to figure out if the company will actually be able to pay us cash while we own it. See, right here, it's a great time to subscribe. Pause the video if you need to, but handle that for me. And this is where we can go to the next group of topics: operating cash flow, dividends paid, operating cash flow to capital expenditures, and free cash flow, cash. I've also made videos on these concepts, so if you want to go back and watch those after this video, then definitely go back. But for this video, I'm going to go through these kind of quickly so we can focus more so on Progressive. Okay, now I've pulled up Progressive's cash flow statement in Yahoo Finance, and first things first, we can see that the company has had strong positive operating cash flow for the last 4 years. And this is a good sign for me. If the company had negative operating cash flows, I probably would have just moved on to the next company. And next, I want to expand this financing cash flow so I can see how consistently they've been paying their dividends. And you see cash dividends paid, how it's actually been growing over this last 4 years. And this means that Progressive has been paying out more and more dividends to its shareholders. And I can close that out. And next, I want to look at the operating cash flow to capital expenditures. And this shows me that of the $6.9 billion of cash that they bring in from their day-to-day operations, how much do they actually have to spend on their capital expenditures to keep the business going on? And we see that of the $6.9 billion of cash they bring in from their day-to-day operations, they only have to spend $223 million on their capital expenditures, which is great. And then lastly, to get the free cash flow, you take the operating cash flow and subtract out the capital expenditures. And the free cash flow is typically where the company pays us a dividend from. So we see that they've had strong positive free cash flow in the last 4 years as well. So will Progressive be able to pay you cash while you own its stock? Most likely. And now we can go to Progressive's balance sheet and look at its return on equity in order to solidify that it's a great business, because so far it's looked pretty good. Now, in looking at Progressive's balance sheet in Yahoo Finance, there's a few things that I want to highlight and be aware of. First, because Progressive is an insurance company, its balance sheet is going to look a little bit different from the companies that we looked at in the past, like Apple or Neo. But we can see their assets compared to their liabilities. And we see that on December 31st, 2020, their assets amounted to $64 billion and their liabilities amounted to $47 billion, which is good. But now we can expand this to see the breakdown of their assets and liabilities. And it's just a few things that I want to be mindful of. I don't have to look at all of these assets. But I see that their total investments amounted to $47.5 billion. And again, remember how the business generates its income is it takes the cash that the customers give them for their premiums and they invest it. So this is what's being shown right here. And then coming down, I see that they have receivables of $12 billion. And when you expand it, it's just the accounts receivable. And this just shows that there are other companies or people that owe Progressive cash to the amount of $12 billion and they just haven't paid the cash to Progressive yet. So it's like them saying, hey, I owe you this cash. And Progressive definitely hopes to collect on all $12 billion of this. So these are the highlighted points that I want to look at in total assets. And now we can look at ones from the total liabilities. And then we see that the policyholder liabilities amounted to $33 billion. And of that $33 billion, unpaid loss and loss reserve amounted to $20 billion. And this is the money that they set aside just in case people start filing claims on damaged houses or cars. And Progressive has to pay them in order to cover their losses. And then next you see unearned premiums of $13 billion. And this just means that customers paid Progressive money in exchange for insurance, but they paid in advance. So for example, let's just say that today you purchase an insurance policy from Progressive and it covers you for the next 6 months, but you pay up front. So Progressive will take your money, but now Progressive is on the hook for giving you the service for the next 6 months that you paid for in advance. So this is what this figure is showing you. And then I come down to look at their long-term debt versus their equity. And they're not heavily leveraged, meaning that they don't have a lot of debt. So they have around $5.3 billion of long-term debt, and then equity in the business is $17 billion. So looking at this balance sheet is actually a strong balance sheet. I don't have any concerns that the company will be insolvent, basically won't be able to pay their bills, and will have to file for bankruptcy or shut down in the immediate future. Now let's look at return on equity. So we see that the equity in the business is 17 billion. And we want to see how well they manage this equity by seeing how much income they generated compared to this 17 billion. So I like to look at this in relation to both net income and free cash flow. So as far as net income, we see that, again, total equity is 17 billion. And then their net income was 5.6 billion. So this shows a return on equity of over 33%, which is great. And it looks even better when you compare the 17 billion of equity to the free cash flow of 6.6 billion. And now that we've done some research, if you feel good about the business, you can look at it and say, okay, I actually like this business. I want to buy it so I can become an owner. And this is when you look at the price in order to see how much you'd have to pay in order to buy ownership in the business. Now, you want to buy a great company at a discount. That's how you make a lot of money. You don't want to overpay for it. So now I'm going to pull up Yahoo Finance and take you through my thought process on why I decided to buy Progressive at $90 per share. So because the stock price is just the market cap divided by the total number of shares, it's better to look at it as if you're buying the whole company. So this is telling me that if I wanted to buy the whole company, I could purchase it for around $56.1 billion. In real life, you have to pay a premium to buy out the other shareholders, so it'll be higher than this, but we're going to use the 56 billion. Now keep that figure in mind, 56 billion. So when we come over to the financials and we go to the cash flow to see how much cash this business has been producing, we see that in a trailing 12 months, it produced free cash flow of 6.6 billion. And on average, over the last 4 years, it's produced an average of $5.5 billion in free cash flow. So let's just say we take the more conservative number of $5.5 billion. And remember, the market cap of the business, or the price that you could buy the whole business for, was around 56 billion. So then you just do some simple math and say, okay, if I bought this company at 56 billion, and on average it's produced around 5.5 billion of free cash flow every year for the last 4 years, then if I bought the company today, it will pay me back the cash that I spent in order to buy it in a little over 10 years. And in 10 years, if I continue to hold the company, then I still will own it, and then it will have paid me back the cash that I paid for it. And this is when you have to use instincts and other factors and say, okay, do I feel like this business will be around and growing for longer than 10 years? Now, if the market cap or the price of the whole company was over 100 billion, then I would have to extend the 10 years out to saying, okay, this company will probably pay me back in around 20 years. And if this was the case, I probably wouldn't have paid for it because I want to get my money back as quickly as possible to reduce my risk. And that's it for the quick analysis of Progressive as a business. But to end this video off, here are another couple factors to be mindful of. One is to be mindful of Progressive's competitors. Who is Progressive in direct competition with? You can look at different insurance companies like Allstate, Aflac. You can't look at Geico because it's private, but see how each of these companies match up with Progressive and invest in the one that you feel is best. And two, I'll say this time and time again, investing is very much an art. You have to use your instincts. I feel pretty good about insurance as a business in the United States for the next 30 years. I feel like people are going to need insurance, and I know who the top players are. I see their commercials on TV day after day. But I don't know about insurance in India. So would I pay the same amount for an Indian insurance company that I would for an American one? Probably not.
But the truth is that if I've got $10 in my pocket that I received as a dividend from a business, it doesn't make any difference whether that came from Wrigley's Chewing Gum or from an internet company. I mean, the money spends the same. So the test of a business is not whether it does something glamorous, something new. It's how much cash it's going to produce over time. It's the only test. I mean, the reinvesting is laying out money to get more money later on. Why lay it out otherwise? And the money doesn't know where it comes from.